In this low yield environment, you might think that it's difficult to get an income on your investments. Actually, that's not true. You just have to know where to look and also what risks you have to take in order to get your hands on that dividend yield. So in this video, we're going to look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The problem for income investors is low risk-free rates. Here's one from the Bank of England since its foundation in 1694. Notice how it spent centuries bouncing around a 5% rate, but at the moment it's fallen to record lows. One way to think of risk-free rates is as a foundation on which are layered all other rates. And those other rates are kind of like boats on a tidal river. When the risk-free rate falls, as the tide goes out, then so do the rates on those other investments. And at the moment, the tide's pretty much completely out because those risk-free rates are very close to zero. And in turn, that's pushed down the other yields to very low levels. Here's the US 10-year rate, and you can see the tide going up to about 15% in the early 1980s. And since then, it's been pretty much steadily falling until it's reached record lows recently. And here's the yield for AA corporate bonds in the United States, which is a little bit above that because there you're taking a credit risk, and the extra yield compensates you for that risk. But notice how when the risk-free yield falls on the government bonds, the yield on the AA corporate bonds falls in line. And the same is true of junk bonds. They have a bigger spread to those risk-free rates, but when the risk-free rates fall, so do those of junk bonds. Now in the UK and in the US, we don't have negative rates yet, as of October 2019. But in the UK at the 5-year point, we're not too far away. It's below 0.5%. But in Japan, rates have been negative for some time, and more recently, they've also become negative in the Eurozone, particularly for Germany, which has a very low credit risk. Now in this video, I won't be talking about individual bonds. Everything I talk about will be for funds. And here you can see how to work out what the dividend yield is for a fund and what it means. The dividend yield is just the payments that you've received over the past 12 months. Those are the dividend payments divided by the price today. And if you want a high income, you want the dividend payments to be as big as possible over the small price that you pay for it today. And that'll give you a big dividend yield. So for example, if the income over the past 12 months on your investment was £5 and you paid £100 for that investment, then the dividend yield would be 5%. So a very important question is how long will we continue to have very low rates? Now this isn't fully understood, but one of the factors is low productivity. Productivity is how much each worker produces per hour. Now long-term rates, that's the long end of the yield curve, is very much driven by both inflation but also growth expectations. And if growth expectations are lower and lower productivity would tend to push that down, then it also pushes down interest rates. Now to see just how bad productivity's been in the UK since the global financial crisis, look at this trend from 1994 up to 2008. Notice how there's a fairly steady growth of productivity. But notice how after 2008, that rate of growth suddenly comes to a halt. And if we saw that trend continue, we'd be well above where we are today in productivity terms. Now that seems to be a structural change. In other words, a very long-term change. So it's very unlikely that we'll see productivity growth shoot up in the near future. And while that remains the case, then it's probably also the case that we'll see low rates for a very long period of time. And there's a lovely article from the IFS, the Institute for Fiscal Studies, by Jonathan Cribb and Paul Johnson. The last decade, they say, has seen record after record broken. But they're not good records. It's record low earnings growth, low interest rates, and low productivity growth. But also record public borrowing, alongside record cuts in public spending. And unfortunately, economic growth remains sluggish. And demographics are not in our favour because the population's ageing quite rapidly. And this points to continued low productivity, low growth, and low yields. And this productivity story isn't specific to the UK, it's a global phenomenon. Now in this low yield environment, the natural response from investors is to reach for yield. That's because there are fewer assets which generate high income, and so those assets become extremely popular. And that's called the reach for yield. As all the good quality assets get bought up, their yields go down. And then you have to reach for ever more risky assets, so sometimes this is also called the dash for trash, or slightly less politely, the flight to shit. But it's not just retail investors like you and I which do that reach for yield. It's also institutional investors like pension funds, hedge funds and insurance companies. And in this World Bank paper by Kalomiris, Lorraine, Schmuckler and Williams, they go into some examples of this institutional reach for yield. Now, the reasons why emerging market debt gives you such a high yield is because it's risky. Emerging market sovereigns default on their debt. You don't have to look far in history to see examples of that. But in a low yield environment, investors are quite willing to risk their capital in order to get their hands on that extra yield. And you can see that in these flows, in other words, movements of capital, as investors buy emerging market debt. And of course, the natural response of companies in emerging markets is to say, fine, there's a demand for my debt, so I'll issue more. Particularly if that debt can be issued at a very low borrowing cost. So we saw that rise between 2000 and 2008. Then there was a dip during the global financial crisis, but of course it started again. And there's been huge issuance in emerging markets of corporate bonds. And one of the risks of these reaches for yield is that we have a build-up of this low quality debt. And at some point there has to be a day of reckoning. So you always have to be cautious when you see this kind of behavior. Now, if we look at the set of funds which are issued by Vanguard, we can sort them according to their dividend yield. And this ranges from 1.1% at the bottom of the table up to 5.2% for the highest dividend yield fund. Now, we should always bear in mind that the inflation target for the Bank of England is 2%. And at the moment, we're not far away from that 2% inflation level. So anything below that yield will be negative in real terms when we subtract the rate of inflation. So ideally, we'd be looking to get a yield which is much higher than that 2%, and that restricts our choice of funds. What's interesting at the moment is that UK Equity Income, which is a fund that specifically selects for stocks which have a high dividend yield. And because the price of UK stocks hasn't been great, that tends to flatter the dividend yield for UK stocks. And that's why this one has the highest yield at the moment. And Vanguard's FTSE 100 tracker isn't far behind, with a yield of 3.6%. Other high-income funds tend to be sovereign bond funds from emerging markets, such as VEMT. And regular viewers will know that at the moment, this is part of my portfolio, and I bought it for this very reason. Pacific ex-Japan equity also tends to be very generous with its dividends. This is very much dominated by Australia, and that has many mining stocks and many financial companies which are typically high dividend payers. And given the relatively high risk-free rates in the US, investment-grade corporate bonds in the US also give a fairly good yield of 3.4%. Then we have a couple of European equity funds, one tracking the Eurostoxx 50 index of large-cap European stocks, and one that tracks the FTSE Developed Europe Index. So your choices at the moment are very much dominated by UK equity, or Pacific ex-Japan equity, which is mostly Australian equity, and US corporate bonds, but also emerging market government bonds. Another way of looking at that is in terms of the risk that you have to take for getting that income. So on the x-axis, we have the volatility of each of those funds, with high risk on the right and low risk on the left. And on the y-axis, we've got the income, with high income at the top of about 5% and low income at the bottom of about 1%. And if we consider inflation at 2%, that rules out the very bottom of the graph, because those funds would currently give us a negative real yield. I've shown equity as triangles, and you can see that dominates the right-hand side of the graph, because equity tends to have a high risk and a high volatility. Whereas bond funds I've shown as circles, and you can see those are on the left of the graph because they tend to have lower volatility. Now ideally we'd be looking at low risk, high yield funds in this top left corner, but as you can see there aren't many of them. US dollar denominated emerging market government bonds are fairly good, but they do come with quite a high volatility of almost 10%. US investment grade bonds have a much lower volatility, but also a much lower return of about 3.2% at the moment. The colours on the graph tell you the cost of the fund, and I've split it into three groups. The markers in blue are the funds which have the lowest ongoing charges. Green is intermediate charges and red is high charges. Now, unfortunately, many of the high yield funds tend to also be red. And that's partly because the underlying bonds are quite illiquid. Because in order to track an index, the fund manager has to continually buy and sell the underlying bonds. And that's more expensive when the underlying bonds are illiquid. We can do a more general exercise with a list of exchange-traded funds. And I've whittled down a universe of several thousand exchange-traded funds using this filter. I only look at sterling-denominated funds, so they can be bought on a London Stock Exchange in sterling. I only consider large funds which have assets under management of over 800 million, and I've created a yield cutoff. So anything with a dividend yield of less than 3% doesn't appear on this list. And you can see the list is dominated by iShares funds. There's also a bit of PIMCO and a bit of UBS, with the odd Spider and Lixor fund, but iShares definitely dominates. And again, the yield goes up to about 5.6%. And now the choices are high yield US dollar denominated bonds. So here you'd be buying junk bonds issued in dollars, emerging market local government bonds, more US junk bonds with short duration, so you're not taking much interest rate risk. And here we get the same thing from PIMCO, but this fund is sterling hedged, so you're not taking the dollar to sterling currency risk. Whereas in this fund, you get the same bonds, but you do take the currency risk. And this one is a European equity fund. Then as before, we get some UK equity and finally some property funds from iShares. If we repeat the plot with volatility on the x-axis and dividend yield on the y-axis, what's interesting is that we finally have something in the top left-hand corner. This iShares High Yield Sterling Hedge Fund doesn't take currency risk because it's sterling hedged, but what you are taking here is US junk bond credit risk. The volatility is low, but the credit risk is high. And in the credit world, volatility is not a particularly good measure of risk. So what you should be watching out for in that market is a widening of credit spreads and a deterioration in credit quality. And if you can get access to it, the rate at which companies are being downgraded, because that tends to pick up when you get a credit sell-off. PIMCO has an even lower risk fund, which unfortunately comes with quite a high fee, but that's sterling hedged, so you're not taking a US dollar to sterling currency risk. You're not taking much duration risk because it's short-term bonds, but you are taking a high credit risk. And we also have this emerging market sovereign bond fund, which is sterling hedged, but the yield there is a little bit lower. It's below 5%. Unfortunately, I use some jargon in this video, such as duration and credit risk, but all of that is beautifully explained in this course I've created called How to Choose a Bond Fund. So if you want to learn more about bonds, this is a great place to do it. It's got 5 videos covering the major types of bond, and I also review the funds that you can buy to give you exposure to each different type of bond. Sorry to plug that, but I couldn't resist. Now, I've talked a lot about the risks, so now we'll go into a bit more detail on some of those funds to see what kind of risks you're actually taking. And we can start with emerging market government bonds. So here's the iShares JP Morgan Emerging Market Local Government Bond Fund. It's dollar denominated, so you would be taking the dollar currency exposure versus sterling. And this is buying emerging market government bonds denominated in their own currency. So if it's a Brazilian bond you buy, it would be denominated in Brazilian reals. So it's nice to see that the fund is quite diversified. There's not a huge exposure to a single country. And if we look at that geographic breakdown, you can see that it's only 10% in the biggest allocation, which is Brazil. Now, if there is an emerging market sell-off, then at least you'll have some degree of diversification. But generally, when there is a risk-off move in the markets, as equity markets sell off and investors get more cautious, emerging market currencies also tend to sell off. And that would be a double whammy for your fund, because people would be pulling money out of the currency and the individual emerging market bonds. If we look at the maturity, they tend to have fairly long duration, so you certainly are taking some duration risk, which means that you'll make a loss if yields rise in emerging markets, and you'll make a gain if yields fall in emerging markets. And because this is an emerging market fund, the credit ratings tend to be fairly low. Anything below BBB is a junk bond, and that's about a quarter of the allocation of the fund. But there's also a fairly big chunk of highly rated debt in the fund. About a third of it is single A. Another type of risk which you can take in order to get some dividend yield is developed market credit risk, which you get with developed market junk bonds. And here's an example of that. This iShares dollar-denominated high-yield corporate bond fund is sterling hedged, so you're not taking the currency risk in this case. It gives you diversified exposure to sub-investment grade rated bonds, known as high-yield bonds or junk bonds, and you also get some sectoral diversification. And by sectors, we're talking about different groups of companies: industrials, utility companies, and financial companies like banks. And because the underlying bonds are quite illiquid, the ongoing charges figure is quite high for this fund, 0.55%. But if the yield's above 5%, you're not so worried about the ongoing charges figure. It's a dollar-denominated bond fund, so as you'd expect, the US dominates the geographic exposure at 90%. And if we look at the credit quality breakdown of the fund versus the benchmark, the fund's in blue, the benchmark's in black, and anything that's below BBB would be considered a junk bond. Now most of it is at the highest credit quality of junk, which is BB, but there is some single B, about a third of it, with a little bit of CCC. PIMCO also has a short-term high-yield corporate bond fund, so you do have this alternative to iShares. And this is a passive fund which is tracking this ICE Bank of America Merrill Lynch 0 to 5 year US High Yield Constrained Index, sterling hedged. Now property is another source of income, but the yields here aren't as high as they are for the emerging market bonds, for the junk bonds, and for some equity funds. As an example, we'll look at this iShares Developed Markets Property Yield ETF. This is sterling hedged, so you're not going to take a currency risk, and it gives you exposure to developed market real estate companies. And it has a lower bound of forecast dividend yield of 2%. And the fund buys listed real estate companies and real estate investment trusts, also called REITs, from developed countries, excluding Greece, which comply with this minimum 2% dividend yield criterion. The geographic breakdown, again, is dominated by the US, so here that's 57%. But you do get some global diversification. So Japan is 9%, Hong Kong is 6%, Germany 5%, and the UK is 4%. And it's also reassuring that you get diversification across different sectors of real estate. So if you're worried about retail taking a plunge as Amazon comes to dominate the retail space, that only makes up 20% of the fund. There are also industrial and office REITs, real estate holding and development companies, residential REITs, and hotel and lodging REITs. And finally, we'll look at an example of a UK equity fund. And that's iShares FTSE 100 tracker. Of course, it's in sterling and it distributes dividends as cash payments. The capital gain on the FTSE 100 has been poor compared to other developed market equity markets. But here that's a benefit because it pushes up the dividend yield to 4.7% as of October 2019. Unfortunately, the volatility is high. That's because this is an equity fund. But because it's a developed market equity fund, the ongoing charges figure is absolutely tiny, just 0.07% per year. And such a small fee will be less of a drag on your long-term returns. So yes, it is possible to get a reasonable dividend yield even in this low yield environment. But you do have to take some risks with your capital, otherwise you're just not going to get those returns. But make sure you understand the risks before you take them. If you want to see more of these videos, remember we rely completely on you for our support. So please support us on Patreon. You get to join us on Slack and ask questions anytime. And you get to join us on our Sunday evening live call. And again, you can ask any question you like. It's all for just $5. Very cheap for what you get. And as always, thank you for listening.